After 30 years of trading, I learned that making mistakes isn't the end. It's where real profit begins. Most traders treat a wrong-way trade like a death sentence. But what if every price drop just hands you better odds, not bigger losses? The secret is a battle-tested system where I win, even when my first trade goes wrong. Here's how. It's all about knowing when to add, how much to risk, and why walking away with half a win can beat chasing the perfect trade. Most never discover what happens next. Most people approach trading like a coin toss. They pick a direction, place their bet, and hope for a quick win. The problem is, markets rarely reward that kind of certainty. In reality, prices move in waves, not straight lines. That's where scaling comes in. Instead of going all in at the start, I break my trade into pieces, small entries, spaced out as price moves against me. Think of it like climbing down a ladder, rung by rung, instead of jumping off the top. Each step lower gives me a better foothold for the bounce back. This approach flips the usual mindset. Instead of fearing every dip, I treat each one as a chance to improve my odds. Markets are like rubber bands. They stretch too far, then snap back toward the average. By adding into weakness, I'm not hoping for a perfect entry. I'm building a position that's designed to benefit from the natural tendency of prices to revert. Most traders panic when the market moves against them. I see opportunity because every additional entry lowers my average price and raises the probability of recovery. Scaling is not about stubbornly doubling down. It is a structured method, with clear rules for when and how much to add. The key is understanding that a single bad entry is not a failure. It is just the first step in a sequence. Over time, this method turns the fear of being wrong into a mathematical edge. The real power comes from embracing the bounce, not chasing the perfect call. That is how staged entries shift the odds, turning setbacks into setups for profit. Let's break down exactly how the numbers work. Suppose the market is trading at 100. Instead of buying all at once, I start with 2 contracts at 100. If the price drops to 97, I add 2 more. If it slides further to 95, I double up and buy 4 more. Now I am holding 8 contracts, but my average entry is not the midpoint. It is weighted by size. The math is simple. 2 times 100 plus 2 times 97 plus 4 times 95, all divided by 8. That equals 774 divided by 8, which gives an average entry of 96.75. This average is critical. Even though the initial trade went against me, I do not need the price to return all the way to 100 to get out ahead. If the market bounces just part way, for example back up to 98 or 99, I am already in profit on most of my position. The heavier size at the lowest price pulls my average down, so a modest rebound is enough. But here is the discipline. I never try to squeeze every last drop. When price hits my target, often just a move back toward the average, I close out half the position. That means selling 4 contracts, locking in gains, and reducing exposure if the bounce stalls. The rest stays open, giving me a chance to catch a bigger move if momentum continues, but with much less risk. This partial exit is what turns the math from theory into cash flow. It is not about being right from the start. It is about using structure to turn a red position green and then making sure I actually take the win when it comes. Precision controls. Volatility is the hidden variable that determines how far prices can realistically travel before snapping back. To avoid guessing at entry levels, I use the average true range, or ATR, as my measuring stick. A TR calculates the average daily price movement over a set period, usually 14 bars, by smoothing out the largest of 3 values: the current high minus the current low, the absolute value of the high minus the previous close, and the low minus the previous close. J. Wells Wilder's formula, with its built-in smoothing, is the industry standard for this calculation. Once I know the ATR, I translate it directly into my entry ladder. Each new order is spaced not by a fixed dollar amount, but by a multiple of the current ATR. For most markets, I set my first scale in at 1 to 1.5 times the ATR below my last entry price. If the ATR is 2 points, my next buy comes 2 to 3 points lower. This keeps my spacing wide enough to avoid clustering entries in a choppy market, but close enough to capture the bounce when it comes. This approach adapts across instruments. In futures, I convert ATR to ticks, in Forex to pips. The math stays the same, but the units shift to fit the market's native language. By letting volatility set the distance, I ensure my entries are always calibrated to current conditions, never too tight in wild swings, never too loose in calm periods. This is how the system maintains discipline and avoids emotional knee-jerk orders when prices start to slide. No matter how promising a setup looks, the first rule is survival. Every trade sequence starts with a hard cap. Never risk more than 3 to 5% of total capital, even if the market seems to beg for more. This isn't just a guideline, it is non-negotiable. Before a single order is placed, I run the numbers. How much margin will the full sequence require? If the combined exposure of all planned entries would push me past that risk cap, I scale back or stand aside. The math is simple. For a $50,000 account, the absolute maximum loss allowed per trade is $1,500 to $2,500. If the market keeps moving against me and every entry fills, the worst-case scenario must still be just a paper cut, not a career-ending blow. This discipline means double-checking position size and margin requirements before the first contract is ever bought. If a broker's margin calculator says the full sequence will use up more than my allowed risk, I adjust my ladder. Fewer contracts, wider spacing, or both. The goal is to ensure that even when a trade sequence fails completely, it is a setback I can shrug off, not a disaster that wipes out months of progress. Every professional trader I know treats capital protection as the cost of doing business. Profits are built on the foundation of staying in the game, trade after trade. Mean reversion is the backbone of this approach, and the toolkit to catch those snapbacks is both simple and powerful. Picture the market like a rubber band. When price stretches far from its average, tension builds, and the odds of a snapback increase. The trick is knowing how far is far enough, and that is where indicators step in. The first filter is the exponential moving average, EMA. Unlike a simple moving average, the EMA gives more weight to recent prices, making it more responsive to current market conditions. I use the 21-period EMA on most charts. If price is above a rising 21 EMA, that tells me the trend is healthy. I only scale in on pullbacks during these uptrends, never when price is chopping sideways or breaking down. This keeps me trading with the flow, not against it. The next tool is the Anchored Volume Weighted Average Price, AVWAP. Instead of resetting every day, the Anchored VWAP starts from a key event such as a major low, a gap, or a big earnings surprise. It tracks the average price where real money has changed hands since that anchor. When price drifts well below an anchored VWAP in an uptrend, it is like a stretched rubber band begging to snap back. That is my high probability entry window. Combining the EMA for trend and the anchored VWAP for demand gives me a reliable map for where to start the entry ladder, and just as crucially, when to avoid it. Scaling only works when the underlying market is healthy and trending upward. If the trend is unclear or price starts to behave erratically, the system goes on pause. The first and most important filter is simple. Only scale into pullbacks within a confirmed uptrend. That means price must sit above a rising 21-period exponential moving average, with higher highs and higher lows visible on the chart. If the market is chopping sideways, or the exponential moving average flattens out, every new entry becomes a coin toss rather than a calculated risk. But even a strong trend can turn dangerous. The real threat comes from parabolic extension, a move so sharp and vertical that normal logic breaks down. When price rockets upward at a pace that is several times the current average true range, it is no longer a pullback opportunity. It is a warning sign. Parabolic highs often draw in late buyers, only to reverse violently and trap anyone scaling in on the way up. The rule is strict: never add into a market that has gone vertical, no matter how tempting the setup appears. If prices moved more than 2 or 3 times the average true range in a single burst, hands off. The system is designed to ride the waves, not to catch falling knives after a blow-off top. Discipline here is not optional, it is survival. Only trade when the trend is steady and the market is breathing. Never when it is sprinting off a cliff. Today's markets move faster and punish hesitation. But discipline and risk control, and the math behind mean reversion, remain immune to hype. As volatility reshapes opportunity, the edge belongs to traders who treat losses as data, not defeat. The real profit is mastering your own response, not just the markets.